following paid commercial program is brought to you by TD Wealth.
Hello and welcome to Money Talk. I'm Kim Parlee. After 8 consecutive hikes, the Bank of Canada kept its key overnight rate on hold at 4.5%, but reiterated it's ready to hike again if needed. Alexandra Gorewicz is a portfolio manager, active fixed income at TD Asset Management, joins me now for the reaction. And can I just say, we were chatting, it's nice to actually have something happen that was predicted that actually happened that way. It's been a while.
Yeah, it's been a long while, 12, 18 months.
Yeah. So what do you take from what happened today? Because it was short statement, didn't say a lot.
Yep. What do I take from it? Really nothing notable.
Yeah.
And that's a good thing. It actually means that the data is coming in as the Bank of Canada was expecting in its last monetary policy report. They did touch on the fact that maybe GDP came in a little bit weaker, maybe the job market is a little bit hotter than they were expecting, but by and large, things are progressing as they were expecting, which justified a hold as they told us they would likely do.
Yeah. So what happens from here then? If the Bank of Canada is going to continue to be data dependent, they're going to be watching what they watch. What about what's happening with Canada and the Fed? Because, of course, the day earlier, Jerome Powell had a few words to say, and the market certainly didn't like that.
No, and today he kind of walked back, the notion that they're going to do 50. He hedged his hawkish tilt from the other day a little bit in front of the committee today at the House. But I think overall, it's expected that the Fed could continue hiking and even more than what they've previously communicated. So right now, the market knows that the Fed said they're going to 5.25. Could they go to 5.5? Could they go even to 6%? Yes, and that would be a divergence from the Bank of Canada's pause. But again, Bank of Canada told us today that, hey, if the data is actually coming in a lot hotter or stronger than what we were anticipating, we could hike again. But
where would that divergence show up? I mean, for those, is it like, in the bond market, what do you see? In the currency markets, what do you see? Like, how is this going to play out for the rest of us?
I think from a bond market perspective, the bond market has already anticipated that the Fed might need to do more.
Yep.
And if anything, even the bond market has anticipated that perhaps the Bank of Canada might still have another rate hike under its sleeve at some point down the road this year. So the bond market's kind of anticipating this divergence, so to speak, although not really divergence, it's just the Fed pulling ahead. I think it's the FX market, the currency market, where we're going to see the real impact of the Fed now pulling away from the Bank of Canada. And we've actually seen since this hawkish tilt, if you will, or actually since the strength of the data has been coming through in the U.S., the U.S. dollar has rallied against all of its peers, Canadian dollar included. Yeah.
What in terms of the data itself? I mean, how are you feeling about the data as it comes in and as you watch it? I mean, is it stickier than people are expecting? Or do you have some concerns, or do you think we just have to wait for their interest rates to really have their impact?
Certainly the latter. I do think time is what is needed. This is where I do agree with the Bank of Canada. However, the risk here is that if the labor market stays strong, wage growth will prop inflation up to a higher level than their 2% target. But does it mean that inflation will not come down from current levels? No, it will come down. It just won't be able to hit that 2% target without additional rate hikes.
Mm-hmm. So what are you watching from here on in? What should we be watching from here on in?
Really jobs numbers.
Yeah.
It's jobs. And we have, for the U.S., we have the next jobs number on Friday. Eventually, we'll have more inflation data too next week, but that should continue to show a deceleration. Again, jobs will ultimately determine at what point inflation can no longer decelerate.
How much do you think, I mean, this is, when we look at the jobs numbers, I mean, there is no one jobs market. I mean, there is in terms of how we track everybody and what's actually going on. But you've got tightness in some, professions and not so much in others. Do you think we're going to see some loosening in the job market? I mean, how, from what you're seeing right now, what do you see?
Earnings are the big driver of that, and earnings have been mixed, this quarter. It's not a clear trend across all sectors of the economy, but any sector or any company that has seen or that has required revising its forward earnings expectations has also indicated that layoffs are likely to happen. So this is where things start to get a little bit dicey for the jobs market, because if we see further deterioration in earnings for the second quarter, and I think we'll probably see more announcements across a larger suite of companies and sectors announcing layoffs.
All right, lots to watch. Not the best things to watch, but lots to watch to see what's going on.
Yes, absolutely.
Thanks so much, Alex.
Thanks, Kim.
That's Alexandra Gorewicz, Portfolio Manager, Active Fixed Income at TD Asset Management. Still ahead, in the spirit of International Women's Day, we take a look at how women can take better control of their mental and financial well-being. Plus, we're going to be talking to a trailblazer in health. You're not going to want to miss it. We'll be right back.